Hello, Mary and John. Good afternoon. How are you? Good, good. Thank you for coming today. Today we are going to review your financial plan. Here's the plan outline. So this plan focuses on your goals of estates and gift tax minimization, insurance review, income tax reduction, and aligning your investment portfolio with your high risk tolerance. You mentioned before that you both are in excellent health condition. John had a successful manufacturing business that you recently sold. And Mary, you are a retired high school teacher. John, as a retired business owner, you are collecting 3,200 monthly in Social Security. And Mary, as a retired teacher, you are collecting 1,400 monthly in reduced Social Security benefits and a pension. You have adult children and grandchildren. Have any of these conditions changed? Okay, great. Then let's move on. So the purpose of this comprehensive financial plan is to provide a framework for helping you reach your financial goals and objectives. The plan addresses your financial health, risk management, investment planning, retirement planning, income tax planning, and estate planning, using above information provided to us. You wanted us to prioritize your goals as follows. First, reduce any estate and gift tax liability and ensure all the estate planning documents are in order. Second, review insurance contracts and discuss the implementation of purchasing a long-term care policy. Third, reduce personal income tax if possible. Fourth, recommend a diversified portfolio that meets your investment needs and expectations based on your risk tolerance. You told us last time that you are very willing to take investment risks. Your ability to accept risk is high due to your significant assets base and multiple income streams. You have pension, social security, installment notes income. Just a FYI, the economic assumptions used in developing this financial plan are as below. So we have risk-free rate at 3% and the market risk premium at 8%. Okay, so first we look at your financial health. You are in an exceptionally strong financial position with a total liability and a net worth of 14.4 million. The sale of John's business provides secured income for the next 7 years, and your cash position is adequate for immediate needs. A key strength is the multiple and stable retirement income sources. So the planning recommendations are prepare a detailed statement of cash flow to identify potential savings opportunities and ensure an adequate emergency fund. 3 to 6 months of expense is generally recommended. And plan for the 40,000 liquidity required for the new car purchasing using the current cash or savings. The plan implementation strategies are prepare a complete cash flow analysis, reallocate funds from saving or CDs to cover the car purchase while maintaining adequate emergency reserves. And this is the balance sheet as of December 31st, 2025. Let's look at where your wealth is concentrated. You have nearly 746,000 in cash and equivalents, which is more than adequate for your immediate needs. Your invested assets totaling over 10.2 million are diversified across stock, mutual funds, and your retirement accounts. One unique asset we've highlighted is the 1918 inverted Jenny stamp, currently valued at $1.5 million. This is a significant piece of your used assets, which total $3.45 million. When we look at your cash flow, the numbers are equally impressive. For 2025, your total income was $1,601,997, largely driven by the $1.27 million installments receivable from the business sale. Even after accounting for your lifestyle expenses and a significant $375,000 in federal and state taxes, you had a net disposable income of $1,026,085. This surplus gives us tremendous flexibility to fund the new strategies we are discussing today. Risk management. Then we reviewed all your active insurance. You have two existing universal life insurance policies which provide some coverage. However, you have an unprotected exposure regarding long-term care needs, which can be a significant financial burden. So our plan recommendations are: purchase a long-term care insurance. It's recommended to acquire a comprehensive long-term care policy that covers both facility and home health care. Since both of you are in excellent health, you may qualify for preferred rates. And we are going to review the existing life insurance, conduct a detailed needs analysis to determine if current life insurance coverage is sufficient to meet all estate goals and survival needs. The plan implementation strategies are: request quotes from several insurance providers for a joint or individual long-term care policy that provides daily benefits and inflation protection. And John purchased your universal life policy 25 years ago. And Mary, you purchased yours 32 years ago. Compared to the old universal life products, most modern universal life products offer living benefits and better cash value accommodations. Using 1035 exchange, your older life insurance policies can be replaced by newer life insurance policies without triggering a tax event. This slide is showing you a long-term care policy provided by Nationwide. This is the best plan we recommend to you. It's a joint LTC long-term care policy with a single premium payment of $400,000. The benefits include a maximum monthly benefit of $10,236 per insured. And we also built the inflation protection rider. It's a 3% compound inflation for 20 years. So the total monthly benefits per person would grow to $17,948 per month after 20 years. It provides in total 96 4-monthly long-term care benefits payments. Since it's a joint long-term care policy, that's 96 payments can be used by either John or Mary. And the total monthly benefit per insured in this plan is just below the tax-free per diem payment limit for qualified long-term care benefits, which is defined by IRS every year. Investment planning. So you have a high-value, diversified portfolio across stocks, mutual funds, and an annuity. The key strength is that you expressed high risk tolerance, which allows for potentially more aggressive growth strategies. A potential weakness is ensuring the current assets allocation fully aligns with this high risk portfolio and your goals, especially avoiding tobacco stocks as you requested. So the planning recommendations are update the asset allocation, rebalance the investment portfolio to align with an aggressive asset allocation strategy using the established economy assumptions. Create investment policy statement. Formalize the investment goals, risk tolerance, and constraints, like no tobacco stocks and in a signed IPS. Manage investment notes. Structure the handling of the 3.5 million installments receivable to integrate with the overall investment strategy and manage the associated income stream effectively. So the plan implementation strategies are prepare a detailed analysis of current portfolio holdings, rebalancing towards a more aggressive mix that excludes tobacco stocks. And here is the IPS I drafted. Using total return approach and based on your ability and willingness to take on risk, I will recommend reallocating the 700,000 excess cash into diversified equities. This counterbalances the installment notes and align with your aggressive growth targets. Next is the retirement planning. So both John and Mary are retired and receive stable, predictable income from pension and Social Security. You have substantial qualified retirement accounts, 401k and 403b, which are major financial strengths. So the planning recommendations are maximize the tax efficiency, explore strategies for managing distributions from the 401k and 403b accounts to maximize tax efficiency in retirement. So consider the QCDs. Since John is over age 70 and a half, so he has the potential for making qualified charitable distributions, QCDs, from his IRA. So Mary is not yet eligible. So the plan implementation strategies roll over John's 401k and Mary's 403b into traditional IRAs to facilitate future QCDs. In terms of this strategy, you may want to consult a tax professional on the logistics of making QCDs to your choosing 401c3 charities. Next is the income tax planning. You are currently in the highest federal marginal tax bracket. The sale of John's business via an installment note creates a significant future income stream that needs proactive tax management. The potential sale of the inverted journey stamp also carries capital gains tax implications. So the plan recommendations are tax loss harvesting strategy. Explore opportunities for tax loss harvesting within your investment portfolio to offset capital gains. Basis review for collectibles. Confirm the tax basis of the inverted Jenny step. Likely the value at John's father's death plus improvements. To estimate future capital gains tax upon sale. The estimated gain could be substantial if sold at the projected 2.3 million value. The plan implementation strategies are work with an accountant to manage the tax reporting for the installment notes using necessary forms, and conduct an annual or semi-annual review of the tax situation to implement strategies for reducing overall tax liability. Last but not least, we need to look at the estate planning. The current estate plan uses simple wills and joint tenancy with right of survivorship for key assets like your primary residence. This approach uses the unlimited marital deduction to defer taxes until the second death, but it does not fully minimize the overall estate tax liability for your heirs, which should be the primary goal. Your estate is likely to exceed federal and state estate tax exemption threshold. So the planning recommendations are implement trust strategies, establish an AB trust or other advanced strategies to utilize both John and Mary's applicable exclusion amounts effectively and minimize combined estate tax. Review beneficiary designations. Ensure all retirement accounts and insurance policies have updated beneficiary designations that align with the new trust strategy. The plan implementation strategies are: I will refer you to a qualified estate attorney to draft and execute the necessary trust documents and new wills. Update beneficiary form on all financial accounts and insurance policies to name the new trust as the primary beneficiary where appropriate. And this is a summary of action plan. So the first recommendation is John's 401k beneficiary correction. So it's a high priority. The rationale for this action is John's 401k beneficiary is listed as Salvation Army. This conflicts with your goal to leave retirement assets to your children. So the action should be taken immediately to update the designation to Robert and Ellen immediately. So the responsibility will be client, will be you. And the second action is to implement trust strategies. The priority is high. The reason behind this is minimize future estate taxes as a primary goal. So the time frame is 3 to 6 months. Responsibility, planner and attorney and client. The third action is to purchase a long-term care insurance. The priority is high. So this addresses a major risk exposure while still healthy. The time frame is 1 to 3 months. The responsibility is planner and client. 5 to 9 super funding. The priority is medium. So you can contribute up to 190,000 per beneficiary at once. That's a 5-year forward averaging to kickstart the grandchildren's education funds tax-free. The time frame is 1 to 3 months. Responsibility, planner and client. The fifth action is update the assets allocation and IPS. Priority medium. Ensures investments align with risk tolerance and goals. Time frame is 1 to 3 months. responsibility planner. The last action is roll over 401k and 403b to IRAs, priority median. And the reason behind this action is to facilitate future tax strategies like QCDs. Time frame 1 to 3 months. Responsibility planner and client. These recommendations are prioritized to most effectively address your primary goals and improve your overall financial situation, moving them closer to optimal wealth transfer and risk management. So this is the financial plan I recommend to you. So do you have any questions, comments, or suggestions? Okay, thank you very much. Thank you for your time. Let's keep in touch.